Have you ever wondered how to make your investment portfolio more secure and profitable? If so, like and subscribe now for more answers for these difficult but important answers. Don't forget to press the notification bell for more knowledge information. This question that often leads us to the concept of diversification. Diversification, in simple terms, is about spreading your investments across different assets. It's the art of not putting all your eggs in one basket, a strategy that can help manage investment risks. Picture a rainbow, each color representing a different asset class. Now imagine your portfolio as that rainbow, a brilliant blend of various investments. This is what diversification is all about. It's about the variety, the blend, the mix. But what factors influence this diversification? First, you have the financial health of a firm. You wouldn't want to invest in a company that's on the brink of bankruptcy, would you? Then there's the attractiveness of the industry or market. Some sectors are simply more appealing to investors due to their growth potential or stability. The availability of workforce resources and government regulatory policies also play a role. These are the elements that can make or break an investment opportunity. Now, why should we bother with all this diversification business? The answer is stability. A diversified portfolio reduces the time spent monitoring the portfolio and helps better achieve long-term investment goals. And let's not forget about peace of mind. With a diversified portfolio, you're less likely to lose sleep over drastic market movements. This is because not all investments move in sync. When one sector of the market is down, another might be up. So, while part of your portfolio might be experiencing a downturn, another part could be thriving. This balance helps to offset losses and can lead to more consistent returns over time. So next time you look at your portfolio, think about the rainbow. Are all the colors or asset classes represented? If not, it might be time to add a little more variety to your investment strategy. Remember, a diversified portfolio is more stable because not all investments will move in sync, making it less susceptible to huge movements in the market. Why is diversification so important? One word: risk. In the world of investing, risk is an inescapable reality. It's the shadow that follows every investment decision, the flip side of the potential rewards. But with a smart strategy and a little bit of knowledge, we can work to mitigate these risks. That's where diversification comes in. By spreading your investments across a range of different assets, you're not putting all your eggs in one basket. If one sector of the market takes a hit, your investments in other sectors can help to balance out the impact. This strategy is all about creating a safety net for your portfolio, a buffer against the unpredictable twists and turns of the market. But how do we go about this? Well, that's where the principle of risk mitigation comes into play. Risk mitigation is essentially a game plan for dealing with potential risks. It's about anticipating the unexpected, preparing for it, and having a strategy in place to lessen its impact. A proper risk mitigation plan doesn't just prepare for all potential risks. It weighs the potential impact of each risk and prioritizes planning around that. It's about being proactive, not reactive. It's about taking control of the risk rather than letting the risk control you. So let's break it down. How does a risk mitigation plan work in the context of investment diversification? It all comes down to 4 key strategies: accept, avoid, limit, or transfer. Accepting risk means acknowledging that some level of risk is inevitable in any investment. But this doesn't mean sitting back and doing nothing. It means actively managing your investments to minimize potential losses. Avoiding risk might involve steering clear of certain high-risk investments altogether. It's about being discerning and making calculated decisions about where to put your money. Limiting risk is about setting boundaries for your investments. It could mean setting a limit on how much you're willing to invest in a particular asset or sector, or imposing a cap on potential losses. And finally, transferring risk is about sharing the burden of risk with others. This might involve investing in mutual funds or ETFs, where the risk is spread among a group of investors. Or it could mean using options or other derivatives to offset potential losses. In essence, a risk mitigation plan is about taking a balanced, strategic approach to investing. It's about understanding the risks and making informed decisions to manage them. It's about striking a balance between risk and reward, and investing in a way that aligns with your financial goals and risk tolerance. Ultimately, diversification and risk mitigation go hand in hand. They're two sides of the same coin, working together to protect your investments and optimize your returns. This involves transferring the risk allocation between different parties, reducing the overall risk to your investment portfolio. Now, let's talk about returns. How can diversification help in maximizing returns? The ultimate goal of any investment is to achieve a return, often expressed as a percentage, known as the return on investment, or ROI. This is the profit you make from your investment relative to the cost of the investment itself. But here's the catch. Higher potential returns often come with higher potential risks. Imagine walking a tightrope. The higher you go, the greater the thrill, but also the greater the fall. The same applies to investments. So how do we walk this investment tightrope successfully? That's where diversification comes in. It's like having a safety net under your tightrope, or better yet, multiple safety nets. Each investment you add to your portfolio is like another safety net, reducing your overall risk. But don't just take my word for it. Let's look at the numbers. Studies have shown that a diversified portfolio can yield a better risk-adjusted return than a non-diversified one. This means that for the same level of risk, a diversified portfolio can potentially give you higher returns. Or looked at another way, for the same level of return, a diversified portfolio can potentially expose you to less risk. Now remember that diversification doesn't mean just investing in a lot of different things. It's about investing in different types of things or different asset classes. Stocks, bonds, cash, real estate, commodities. These are all different asset classes, each with its own risk and return characteristics. By investing in different asset classes, you're reducing your exposure to any one type of risk. Economic downturn? Your bonds might be affected, but your real estate could hold steady. Stock market crash? Your stocks might take a hit, but your commodities could even increase in value. So diversification is not just about spreading your investments, but about spreading your risks. And by managing your risks, you're putting yourself in a better position to maximize your returns. And don't forget, diversification is not a one-time thing. It's a process that needs to be maintained and adjusted over time. This is where rebalancing comes in. Rebalancing is the process of adjusting your portfolio to maintain your desired level of risk and return. If one asset class has done particularly well, you might find that it now makes up a larger part of your portfolio than you intended. Rebalancing involves selling some of this asset class and buying more of others to restore your desired balance. So there you have it. Diversification, a powerful tool to help you balance risk and return, and ultimately, maximize your returns. As the saying goes, don't put all your eggs in one basket. Spread them out and watch your investment grow. Investing in different asset classes reduces your exposure to economic, asset class, and market risks, helping to maximize your returns. So, how can you create a diversified investment portfolio? Well, building a diversified portfolio is akin to preparing a well-rounded meal. You wouldn't want to fill your plate with just one type of food, would you? Similarly, a diversified investment portfolio contains a mix of different asset types to ensure a balanced nutritional investment diet. Firstly, it's not just about the traditional battle of stocks versus bonds. While these two are the most common asset classes, they're not the only ones out there. Your portfolio could also include real estate, commodities, or even cryptocurrencies. The key is to explore various asset classes to find a mix that aligns with your investment goals and risk tolerance. Next, let's talk about index funds. These are broad-based investments that track the performance of a specific market index. They offer a simple, cost-effective way to diversify your portfolio. With one index fund, you can own a piece of hundreds or even thousands of different companies. This means that even if one company doesn't perform well, the impact on your overall portfolio will be minimal. Don't forget about the role of cash in your portfolio. While it may not offer the growth potential of stocks or bonds, it provides stability and liquidity. In other words, it gives you the flexibility to respond to short-term needs or to take advantage of new investment opportunities as they arise. Now, onto target date funds. These are mutual funds that automatically adjust the asset mix in your portfolio based on a specific future date, usually your estimated retirement date. As you get closer to that date, the fund gradually shifts towards more conservative investments. This can make managing your portfolio easier, especially if you're not a fan of micromanaging your investments. Periodic rebalancing is another crucial strategy in maintaining a diversified portfolio. It involves adjusting your portfolio on a regular basis to keep it aligned with your investment goals. For instance, if one type of asset has done particularly well and now makes up a larger portion of your portfolio than you'd like, you might sell some of it and use the proceeds to buy more of another type of asset. Finally, think globally with your investments. International diversification can help reduce your portfolio's exposure to risks associated with any one country's economy. This means investing not only in your home country, but also in different regions around the world. So there you have it. Creating a diversified portfolio involves a mix of different strategies, from exploring various asset classes and investing in index funds, to maintaining a stash of cash, considering target date funds, rebalancing periodically, and thinking globally. Remember, diversification is not about chasing the highest returns. Instead, it's about managing risk while aiming for consistent long-term growth. To achieve a diversified portfolio, look for asset classes that have low or negative correlations, so that if one moves down, the other tends to counteract it. Like the different ingredients in a well-prepared meal, each asset class in your portfolio plays a unique role in achieving a balanced investment diet. And that, dear friends, is the essence of diversification. Let's take a moment to summarize what we've learned today. We kicked off our conversation by understanding diversification. It's all about spreading your investments among and within different asset classes. It's like not putting all your eggs in one basket. The idea is to ensure an optimum mix of varied investments to manage risk and maximize returns. We learned that diversification depends on several factors, including the financial health of a firm, the attractiveness of the industry or market, the availability of workforce resources, and government regulatory policies. The key takeaway here is that a diversified portfolio reduces the time spent in monitoring investments, helps better achieve long-term objectives, and brings more peace of mind. Then, we delved into the importance of risk mitigation, a crucial aspect of diversification. Remember, the goal is to plan for potential risks and lessen their negative impacts. The 4 options laid before you when it comes to mitigating risk are to accept, avoid, limit, or transfer. A risk mitigation plan allows you to reduce and eliminate risk, making your portfolio more secure. Next, we explored the role of diversification in maximizing returns. The principle here is simple. To increase return, you must increase risk. But by diversifying, spreading out your investments among a variety of asset classes, you can effectively lessen risk. High-growth stocks were highlighted as potential avenues for significant returns over the long term. Finally, we discussed how to create a diversified portfolio. It's not just about stocks versus bonds. Using index funds can boost your diversification, and don't forget about keeping a portion of your portfolio in cash. Target date funds can make managing your portfolio easier, and periodic rebalancing helps you stay on track with your investment goals. And remember, thinking globally with your investments can further enhance your diversification. In closing, diversification is about more than just spreading out your investments. It's about understanding the factors that influence diversification, mitigating risk, maximizing returns, and creating a diversified portfolio that aligns with your financial goals. It's a powerful tool that can help you navigate the volatile waters of the investment world with more confidence and peace of mind. Remember, diversification is the cornerstone of a successful investment strategy. It's all about spreading your investments and balancing risk to make your portfolio more secure and profitable. Thank you for joining us on this journey to better understand the power of diversification. Press the like and subscribe buttons. Comment below with your opinions, comments, and questions. Press the notification bell for more profitable knowledge for you. Here's to a more secure and profitable investment future.